So in this video, I wanted to talk about a couple of things. Premium versus discount pricing and the law of supply and demand. Basically how they work, what they are, where the concept comes from, and how to tie it into your trading. And for the sake of simplicity, what we're going to do is we're going to use non-trading examples at first, and then we're going to apply it to the chart after. So the concept of premium versus discount is we want to sell on premium, we want to buy on discount. What does that actually look like, and what does that actually mean? Well, there's a couple ways of looking at it. The first way would be, let's say we are in a bullish trend. Well, we don't want to be buying anywhere up here. We want to be buying somewhere in discounts. So the idea is to wait for a pullback somewhere down here, and if our entry criteria all lines up anywhere in here, we're going to basically look for an entry and continue on up. That's the concept. On the flip side of things, if we are bearish, we are obviously wanting to look for sells long term. But if we're looking for sells, we don't want to be selling from anywhere in here because that's discount pricing. If you have to sell on discount, which some days you will, that's fine. Just understand that it is lower probability. All your higher probability sells are going to come from premium pricing. And I consider anything above 60 is a great premium range to sell. Anything below 40 is a great discount range to sell. Or to buy, sorry. And anything between 40 to 60 is relative equilibrium, meaning that you're not really getting a good deal. You're not overpaying. It's just, you're basically paying an average price. So it's harder to make money on things you buy in the relative equilibrium territory. So to explain this a little bit further, let's look at the same example. And let's talk about it in a sense of a PlayStation 5. Let's say the retail value of a PlayStation 5 is $750. You wouldn't buy it for more than that because that's what it's worth, relative equilibrium. Now let's say you see a brand new in the box PlayStation 5 for $500. That's a great deal. You get a discount pricing. You can buy it for $500 and sell it for $1,000, premium pricing, because that's what they are currently selling for because they're in demand and there's a shortage of them. That's the basic idea of premium versus discount pricing. So that is step one to understand how premium and discount works. Step two, we have the law of supply and demand. How does the law of supply and demand work? Well, the concept is we're either in oversupply of something or we're in demand of something. Now, this applies across any market, whether it be corn, soy, sugar, oil, crypto, stocks, forex. It doesn't matter what it is. There's either too much of something or not enough of something. If there's too much of something, that's an oversupply. So we definitely don't want to be buying when something's in oversupply, especially at premium prices. Now, if something is in demand, we expect the price to go up due to getting being in demand. Now, this is kind of the concept if we think about a house. Let's say we have a little house. I'm sure you guys love this drawing. Put a little door here, and we have a great little window. Now, here you have a house. Now, let's say the market is absolutely flooded with houses. Let's say there's just hundreds and hundreds of thousands of houses for sale in whatever city you're from, but there's barely any buyers. What that means is there is an oversupply of houses. So when there's an oversupply of houses, the price of housing actually goes down because there's way too many houses and not enough buyers. Now, on the flip side of things, I think we just lost a window here. Now, on the flip side of things, we have thousands of buyers, but only hundreds of houses, meaning there's not enough houses for all the buyers, which means houses are in demand. So the concept is the price of houses will continue on climbing because there's not enough stock for the amount of people wanting to buy houses. So the Forex market is no different. It works the exact same way. And again, we'll get to the chart example in just a second here. And I actually made a pretty little post for this too. And basically all of that says is what we just talked about earlier. The idea is you want a good price, you want a good deal on your house because if you're planning to make money on it in the future, you don't want to be overpaying for it. So you want to make sure you're paying proper pricing for your investment, because that's what essentially everything is in the long term, whether it be a house or you're shorting or buying currency pairs. It is some sort of an investment. To make money on your investment, you have to have proper pricing. You also have to understand where you are in the current market schematic. Meaning, does the market have an oversupply or are we in demand? Now when there's an oversupply and prices sitting up here, you know that because of the amount of supply, you don't want to be paying premium prices. You want to be buying way lower so you can make money on your investment. So that brings me to the next part of this. And this is premium pricing with supply and demand at the same time. Now, how this works is, the concept is we need to figure out who's in control, demand or supply. Many of you use market structure, at least I hope you do. I do. And the idea is, in a bullish market, every time it comes up, we want to buy and discount and the continuation up. In a bearish market, every time it comes down, we want price to come up back into premium somewhere, and we basically want to buy and short it back down. Now, for step one is identifying what kind of market you're in, and depending on what system you trade, I hope to God you use market structure. If not, whether you use trend lines or whatever you use to determine the current trend, I'm sure there's some kind of system you use. You basically need to determine where you are. In this specific system that we teach at Precision Markets, we're always in a state of supply or demand. Now, when we're in a state of supply or demand, we also understand what kind of pricing we're getting. So, for example, the market is very bullish, but price just keeps on climbing and climbing and climbing. And at this point, we know we're in a very premium price. It's only a matter of time before it retraces and gives us a better opportunity to get into this buy. And the same thing with a sell. So the idea is to determine where the good sell zone is, where the good buy zone is, and ultimately who's in control. Myself, I like to use market structure, and then I'll look to see if demands are breaking or supplies are breaking and where we are on the whole fib. Now, if we just come on over to our chart, let's go to maybe 1 hour. So this is just to break this down for you guys. So this is, this fib's currently pulled on this low to this high because that was our last impulse up. So in this specific example, we know we're in a bearish market. So there's a couple of things to take away from that. We know that anywhere shorting up here is pretty high probability for us. We like that. Now, there's a couple of other things to keep in mind. If this is the last impulse up, and we start seeing a little bit of bullish momentum, there's probably a new impulse to look at. So what I do is I pull the fib myself on the latest impulse. So for example, I had this impulse pulled, and when we were playing these buys back up, I knew I was willing to buy this up to, 50%. Anything above that, I don't really want to keep buying because it's counter trend. We know the long-term target is down. So the idea is if we are playing the pullback, we are buying in discount, and once we're in premium pricing, we don't want to keep on buying because the probability is no longer in our favor. Now, on the flip side of things, I'm just going to go to 15-minute. We have this impulse. So now, on the flip side of things here, if we just decided not to use this, but we decided to just use this latest impulse, which is what I was actually using yesterday. So yesterday we had this impulse down. And again, same as what I showed you guys, I knew that buying up to 50% is fine. Anything above that becomes a little bit riskier because you're buying in premium. So the higher up the leg you go, the lower the probability. At the same time, we know that when over 50% of this fib is filled, being that the higher time frame is bearish, we are ready to start shorting again. Today was one of those days where we were shorting in discount all day, and that's basically the market was just not willing to pull back today. And that's where you have to be able to flex the premium discount a little bit, and I start looking at supply and demand itself. Well, all the supplies are holding, none of them are breaking. I'm going to just take a sell from it regardless. And if it fails, it fails. I know it was poorly priced. When it is poorly priced, I know I'm only going to go for a 5R. I'm not looking to hold for long because it's just not a high probability trade. Whereas if you're with trend and you have the opportunity to, get in up here like our good friends in London do, Hey guys, I just realized my recording stopped, so I'm just going to finish off what I was saying. What I was going to say was, if you got a really good entry like our good friends in London did here, where they are obviously in premium pricing, you can hold that for a lot longer because you got proper pricing. And that is the whole idea of supply and demand and premium and discount pricing applied together. Now, if you can use these concepts together, you'll get into better trades, better price trades, and ultimately the odds will just be more in your favor when you know you're not overpaying for something. So that's why the fib itself is very important. As far as the fib itself, I'm not religious with it where it needs to go on absolutely every single leg. Like I know some guys will, they'll put a fib here and here and here, and they just follow it up. I no longer do that. What I found was if you just pull a 1 hour or 4 hour daily fib and you work with those, it cuts out a lot of the noise. You get on the 15-minute fibs, and you're basically just going to find you're pulling a fib everywhere, and it's not necessary. You just want to know where you are on the larger time frame and whether you're getting good pricing for buys or good pricing for sells. Obviously, the higher time frame bearish expectation is to sell long term, so we know we don't want to keep buying. But that's basically the core concept I wanted to get across. If you haven't already subscribed, definitely do. Thank you for tuning in. Stay tuned for more videos like this, and I hope you have a great rest of your day.